Hi, welcome to the Investment Blueprint. I'm your host, Raghu Kumar from Rain Technologies. The Investment Blueprint is a weekly podcast where you can find me interviewing real-world quantitative traders and investors, hedge fund managers, and industry experts in the field of quantitative, data-driven trading and investing. My goal is simple. I want to help you make more consistent, profitable trading decisions in a data-driven and meaningful manner. In case you want to check out Rain, our website is www.rainfund.ai. Today's topic is on how to do algorithmic trading in India with a focus on the backtesting phase. Backtesting is a tricky thing to do, as any quant will attest to. You need a lot of things to go right with a backtest, and it's very easy for something to go wrong. The idea needs to be sound, the data needs to be high quality in nature, and of course, your code needs to do exactly what it's supposed to do. In case you're caught up on the ideation phase, check out my interview with Sonam Srivastava from Wright Research from last week's episode. Today, we have an expert to school us on backtesting. His name is Rahul Mudliar, and he runs a company called Quidditch Finance. Quidditch is in the business of helping users do everything and anything related to algorithmic trading. Whether you want to invest in trading strategies, or you need a strategy coded, or you want to attend a workshop on algorithmic trading, Quidditch is there for you. Similar to what Rain provides its clients, a client subscribed to Quidditch can avail fully automated trading strategies built by Rahul and his team. Rahul's forte is to build fully automated strategies on index futures. As per the company's website, Quidditch builds strategies centered around technical analysis and price action. Once tested rigorously over historical data, a strategy is tested on out-of-sample data. Following the entire process of quantitative analysis, the strategies are paper traded and capital is deployed with religious execution. Today, we will touch upon different questions related to the process of backtesting a strategy. So Rahul, welcome to the podcast, my friend.
Hi, Raghu. Good evening. Pleasure to be here.
Likewise. So, I thought we could start by just talking about your general introduction to algorithmic trading. How did you get started?
Sure. So, systematic and algorithmic trading was introduced to me by my mentor, Suvit Manjani. He gave me various insights on systematic trading, but at that time it was all rocket science for me. Up until I went on to studying CMT Level 3 examination, that is Chartered Market Technician, where we have to go in details of system design, testing, practical consideration, risk control, and etc. So, and after that, belonging to a non-programming background, learning how to code was another challenge. But with the help of a workshop on AMI Broker AFL coding, I learned a fair amount of AFL coding. So this is how I got started.
Got it. So, how do you think algorithmic trading is superior to, screen-based discretionary trading?
Sure. So it's important for me to maintain a completely unbiased mindset while trading on clients' money, especially for a large amount of capital, as it's very, very easy to lose money while you attempt to trade using intuition, as it is cluttered with conflicting emotions and expectations. This takes away our ability to follow systems, analytics, technicals, or logics. And once you learn proper analysis, may it be technical or fundamental, creating completely rule-based strategies which have a mathematical edge and statistically backed and verified empowers you different scale altogether. Having a well-defined system and process that enables you to to consistently churn out profitable trades and strategies is like having a strong foundation upon which huge infrastructure can be built. So yeah, definitely that's the case.
Got it. So before you got into algorithmic trading, were you trading on your own?
Yeah. So I earned a lot of money in the manual trading.
Got it. So, tell me about Quidditch Finance. And also, tell me about how you came up with the name, because obviously that's a Harry Potter reference. Are you like a Harry Potter fan?
Yeah, so I'm a big Harry Potter fan, and so actually, so this firm has been like started few months ago, and in the time, in the case of COVID scenarios and all that time period, we all were into our homes, and we had a lot of free time. So we happened to watch the series again, and in the meanwhile, I was kind of deciding upon the name of the firm. So I just thought I don't want a orthodox name, and let's find something that catches attention and sounds good. So I wanted to name my firm, on this particular sport. So, and
Sure.
I found this sport extremely fascinating. It's absolutely
Of
beautiful.
course.
Absolutely.
Yeah.
Yeah. And about Quidditch Finance. So, Quidditch Finance is a firm founded on a simple principle to create wealth and keep adding value to those who believe in our mission to systemize trading and investment processes with smart and systematic trading strategies and methodologies. Here, the primary function is to create strategies that are born out of statistically available opportunities backed by technical analysis. These strategies are rigorously backtested on historical data, being aware of the changing market conditions, and then finally paper traded to give an accurate and live metric as to what we can expect out of the systems. The people who are happy with the reports and performance can access the strategy through execution algorithms and capital allocation. And apart from that, we provide other services like programming strategies and providing education through CMT preparation classes and workshop on various topics. So apparently, we are planning to launch a recorded course on option trading within a couple of months, maybe, which will probably cost less than a dinner outing.
Perfect, perfect. What I love about the name Quidditch is it's very unique. It's something no one forgets. Which is obviously very important.
Right, right.
And I'm also a huge Harry Potter fan, so.
Oh, that's glad to hear.
So let's talk about backtesting, right? So obviously, that's the focus of today's episode. Just generally speaking, how do you go about backtesting a strategy? What does your kind of general process look like?
Right. So the process seems complicated in theory, but it isn't that complicated at all. Or maybe you should keep it simple so that you don't lose upon the actual purpose of backtesting and getting engaged in the process itself. So, to put it simply, having a hypothesis, number one, testing the said hypothesis on the in-sample data, the data which you will be using to develop and optimize the strategy. So this in-sample data should be less than 60 to 75% of the entire data set that is available with you. Now, while dealing with in-sample data, although you can have a fun time testing all the stupid ideas, but always be aware of overfitting. Everything that we do, we must ask ourselves, is there any sense or logic behind it? Or are we just trying to create an artificial report which looks good? While you test, you can check how sensitive your strategy is for small parameter changes, right? And if there is some range of parameters that gives roughly the same results, then you can say that our parameters are stable, right? So once you know the parameters are stable, you can optimize within the parameter set itself, but we should be aware of overfitting while optimization. Well, and the solution is to test on another period that was not at all used in optimization process. So this data is called as out of sample data. So out of sample data, once you touch this data, then it's no turning back. The strategy
Mm-hmm.
as a complete bracket, depending on the result of the out of sample test, will either be forwarded to the next test of whole data and paper trading and stuff, or else it will be put into dustbin. So this is
Sure.
this is rigid rule. This is extremely
Got it.
important.
Got it. And how does one think about splitting that data into in sample and out of sample?
You don't need to actually complicate that particular thing. You can simply have 60 to 70% as in sample data, and you can either split it like a 10% data as in sample, then another 2-3% as out of sample. This is called walk forward test. Or else, if
Hmm.
you want to keep it extremely simple, and even I try to keep it extremely simple, you can simply have the initial 60 to 70% of the data as in sample data, and rest of the recent data as out of sample data.
Got it. Got it. Okay. So, what are some common mistakes that people make, when they go about backtesting a strategy? Obviously, you deal with a lot of different types of individuals in this space and you teach a lot of students and, you have your own team and you also build your own strategies. So whether it's you, making these mistakes or the mistakes you see others make, what are some common mistakes that people make?
There's a hell lot of mistakes out there.
Yeah.
First of all, they try to develop a strategy rather than validating a strategy. You know, understanding
Hmm.
the nature of backtesting or validation is very important. It's about having a well-defined hypothesis at first, and then going on to test or validate the credibility of that idea. Now in case that the idea shows some sort of an edge, then we can play a bit with the optimization process, trying to find parameters and rules that are improving the performance of the strategy. But at
Hmm.
first, you must have some sensible hypothesis in your hand.
Hmm.
And so this is like a first common mistake. And apart from that, wrong handling of out of sample data. If, for example, the results are not good in the out of sample data set, and the quants try to improve the strategy upon the out of sample data itself, as it takes considerable amount of courage to discard the set of rules if the strategy did not perform in the out of sample data. If you don't discard slowly after several attempts, the out of sample data will also become seem like in sample data, and there will be a higher chance that the strategy has been overfitted.
Hmm.
So, and other than this, like relying too much on backtesting, not understanding the limitation of the process, we have to understand this is just a limited check on a limited amount of data and time, and that too under different market conditions. There have been many instances in the market where brilliantly backtested strategies failed miserably in the real market, simply
Hmm.
because the condition of testing and the deployment were different. Other
Hmm.
than this, like following the right process is more important than getting good backtested result.
Hmm.
Developing a training system can be difficult, but there is a right way and a wrong way of testing to arrive at a credible result. So a credible result doesn't really prove anything. It's upon the person who has gone through the process knows himself that these results have been come up with a right process or a wrong process.
Hmm. Hmm.
Yeah,
And obviously, part of that process involves also, paper trading
obviously.
and forward testing and eventually, trading a strategy live. How do you think about paper trading? How long do you paper trade a strategy? Um, Slash, forward test a strategy, and when do you kind of think about taking that thing live?
See, that again depends on the risk appetite of the system designer and the people who are ready to deploy capital. But generally speaking, depending that is a question which is dependent upon the time frame of the strategy. Like let's say if there is a strategy which holds on to a trade 6 to 7 months period, so you cannot really invest a couple of years into paper trading. But if there is a strategy which is kind of giving you 10 to 15 or 20 trades in a month, you can invest a couple of months in paper trading.
Got it. Got it. Got it. Okay. And is that a part of your process? Like when you build strategies, do you always look to, paper trade a strategy before you trade it live?
Absolutely, absolutely. Minimum for a month.
Got it. Got it. And what are some certain metrics you're looking for in that paper trading environment before you take it live?
In paper trading, actually, I don't really look for performance. So it is very possible that the performance is not so good in the paper trading phase. So in paper trading, I generally look for whether the algorithms are taking trades properly as per the intent, and whether all the processes are right, whether it is kind of adaptive to the current market situation. I just check whether it's not doing something completely weird, and I check whether all the trades are executed properly. That is what I look for in the paper trading process.
So you don't check the performance
I
of the
don't
paper
check.
trading environment.
I don't check.
Interesting. That's very interesting. Okay. Okay.
See, the reason behind is like the time frame of the strategies that I have. So it is
Hmm.
very possible to go into a drawdown which may last for a quarter or two, maybe a couple of
Right.
quarters. So you cannot really judge a strategy on the basis of a paper trading of a couple of months or a month, maybe.
Sure. No, that makes sense. Yeah. As
Yeah,
long as I guess the performance is not worse than what, the worst case scenario calls for, right, in the backtest.
absolutely.
So obviously, you're very well, immersed in the whole Indian scene, and you kind of know, what's available and what's not available in India. And obviously, the algorithmic trading markets in India are still evolving, and it's still a relatively new space. For our listeners out there, what's available in India right now for algorithmic trading? What are some good general resources for quants to kind of learn more about backtesting and things like that?
So, according to my knowledge, to learn the backtesting process in detail and be able to do so, an aspiring systematic trader must go deeper into two aspects. One is programming. One can look at it as a tool. We need to have coding skill to code the strategy and then be able to test it. The only two reliable tools that I know, as per my knowledge, is learning Python, or you can go for AFL Army Broker. For learning
Hmm.
Python, one can consider going for the EPAT program organized by Quantensity. And to learn AFL Army Broker, one can check out the courses offered by R. Rajendran from Market Calls or Suvit Manjani from Dravyanidhi. And the
Hmm.
second aspect of it is knowing and understanding the structure, path, and systematic process of backtesting. One can consider it as a knowledge of the process. Now, this is more important than the programming language itself or any other tool that you are using. As we know, a fool with a tool is just a greater fool, right? The best resource and the best resource for understanding the entire process of systematic trading, backtesting process, the best resource is going on to check the books written by Charles D. Kirkpatrick and Perry Coffin. They have written
Hmm.
wonderful books upon these
Hmm. Hmm.
topics.
Got it. Got it. How did you get into programming? Just curious to know that, because obviously a lot of quants are not able to make that jump. To go from just kind of thinking about a strategy in a quantitative manner to actually learning how to code and spending that time. So, how did you kind of get into the programming element?
Yeah, I did mention about this earlier. Like I was
Right.
introduced to all these things by my mentor Suvit Manjani. So he
Right.
also introduced me to the AFL programming language. So at that particular point in time, they were offering a workshop on that particular tool. So I did
Hmm.
attend that workshop and learned a lot about the AFL coding. So today, everything that I do, I use AFL Army Broker as a primary language and tool.
Got it. Got it. Perfect. So let's go to the next question. I mean, obviously, there's different ways of backtesting a strategy, and ultimately, there are certain things you're looking for in a good strategy. What are some kind of factors you're looking for in a strategy in terms of what makes it viable to trade it live?
So again, like first of all, for the strategy to be viable, it should be born out of some sort of a sense or logic. So
Right.
I'm being redundant over here, but this is extremely important. and
Sure,
then
sure.
the factors that I look for are few metrics: the
Mm-hmm.
number of trades, like minimum of 100 trades at least. Then the
Okay.
win rate is like a minimum of 40% win rate for a trend following strategy, and a minimum of 60% for mean reverting or specifically breakout strategies. And then MTD, so not more than 15 to 20%, but again, it's very subjective. And then CAR to MTD, that is cumulated annual rate divided by max drawdown, that should that should be more than 1.25. About 1.75 would be great. And then
Mm-hmm.
sharp ratio, it should be about two for me to take strategy live.
Okay. Pretty high threshold. Yeah. That's amazing. And let's talk about risk management a little bit. Obviously, one of the most critical elements of a proper trading strategy. How do you think about stop losses? And when it comes to your strategies, generally speaking, what types of stop losses do you use?
Right, right. Well, this is extremely important aspect because it ensures your survival. One thing that I would recommend to every strategist is to have a fixed percentage stop loss on every trade before you enter the markets. So there are two aspects to this. Number one, like you must have a clear picture of max loss so that you can ensure that you are not losing more than 2 to 5% on a single trade. The secondly, it's extremely important to have trade level risk management in place because without trade level risk management, you cannot have a proper capital or portfolio level risk management.
Mm-hmm.
And when you have trade level risk management, it's very easy to have some sort of portfolio or capital level risk management in place.
Mm-hmm.
So, depending upon your appetite and the volatility of the instrument that you are trading, you must have a fixed percentage stop loss. For example, if you are trading something like Bank Nifty futures, then 1.5% below your purchase price is a good idea.
And how do you come up with that number? Is that a function of your back tests or just kind of knowing the product?
It's kind of like knowing and understanding the product well,
Right.
and it's kind of a threshold beyond which I won't be comfortable losing upon on a single trade, and also considering the volatility of the particular instrument.
Right. Yeah, it makes sense. Makes sense. So, obviously you've been trading in India for a while. What are some issues you face, trading algorithmically in the country?
Yeah, so like nothing specific to India, but personally, I found it challenging to pull off the auto execution part. So either one must be willing to invest in hiring professionals who can build the entire bridge for the strategies, which should be robust at the same time, or a cost, or there is an option like which is cost efficient and a better choice for individuals or small firms is to take the service of third party bridge providers. Now these are the people who are bringing in a great amount of change. These are the people who are making it extremely easy to trade algorithmically in India.
Got it. So in terms of execution issues or broker related issues,
Right.
you're saying basically everything is pretty smooth sailing.
Yeah, so because of these sort of companies who are providing a third party bridges and a
Hmm.
solution for the execution part. So the
Right.
execution part is not as simple as coding a strategy. So you may happen to code a strategy pretty smoothly, but executing is a difficult task. At least I face this particular issue.
Sure. Sure. Got it. So let's talk about, your goals and your company's goals. Where do you kind of see yourself and Quidditch Finance, in the next like 5, 10 years?
To be honest, like I don't see myself or Quidditch Finance anywhere. So it's kind of I am not a very long term looking guy. I believe in being present and admiring the present moment. So whatever I do, I tend to recognize that the process is going to lead me to greater heights, not the vision, not the plans, not the excitement, not the desires. So I am a firm believer of respecting the present moment. Whatever work that you have in your hand, you should do it with utmost respect and utmost consciousness. So I personally have no great plans. It's just that I wanna do good work. Like for example, we are talking. I just want to talk in a right way and transmit the knowledge that I have. It's like no greater plans. So it's very simple for me. I want to pull up good work rather than achieving great things.
I love it. That's a great answer. And I think in this space, that's very important because the markets are always evolving, right? So you cannot get so caught up in something you've done already. You have to always be in the moment and looking to evolve.
Absolutely.
So, the last question, Rahul, is, any last words of feedback you have to, any aspiring quants looking to get in, on algorithmic trading?
Yeah. So it's like I would advise them to stop burning your money and start burning your fingers. Start the trial. It looks difficult at first, but it's not that complicated at all. Start observing charts and try to have some technical insights from experienced traders. Define these into simple rules, learn some coding language. You can prefer learning Python if you want to build mathematical model. But if you are happy to stick with technical analysis like I am, then AFL AMI Broker is the best option out there. Understand the process of systematic trading, backtesting, or validation. Know the nature of strategy that you build, because you can have full confidence in a method only when you understand it clearly. So it's like understanding is like an engine and execution is like an accelerator. If any one of them is not there, your vehicle is of no use, right?
Right.
So that's it.
So thank you so much, Rahul. That was an amazing interview. And
Glad.
if anyone wants to, get in touch with you, what's the best way to do that?
So they can email us at info@Quidditch Finance.
Okay. Thank you so much.